Adrian, thanks for joining us.
Thanks, Tom. Great to be here.
Where do we find you this morning?
I'm at home in the office.
Is home Sydney for you, Adrian?
Yeah, home Sydney, Blue Mountains. I live in the Blue Mountains, Lower Blue Mountains.
Oh, fantastic.
So we're going to get into a range of really interesting topics, especially around the investor perspective. But how did you end up in this game to begin with, given you started life at PwC?
Yeah, that's probably an interesting question. I started life at PwC as an accountant, which makes me boring in a lot of people's minds, but I quite like the background. I got really lucky when I was young that I worked predominantly in the private client sector and working with a fairly broad cross-section of private businesses. I started work in the mid-90s and so got to see the first dot-com 1.0, the rise and crash through that. I had a couple of managers that got me involved and offered me the opportunity to help companies start raising capital, write business plans, when almost any fish and chip shop could put a website up and call themselves a .com. And so I saw that experience, and that gave me this opportunity to see the future of the internet. If I then roll forward through the crash period, I'd actually sold an investment property, I think it was 2008, 2009, and was starting to look at where I could start consider investing funds. And I had standard listed investments. I thought I could just do more of that, but that was going to be as boring as hell. And I just started seeing some more stuff around angel investing. So I thought, you know what, I'll go and have a look at some of that stuff. Met up and saw Sydney Angels and joined in with Sydney Angels. Started seeing opportunities through there. And the rest is history, so to speak. And I just love the opportunity of working with high growth, smart people, high growth companies doing smart things, smart people, trying to change the world. I love the David versus Goliath kind of battles.
Yeah, it's really interesting. My first job after uni was actually PwC as a grad. I only lasted 9 months. I was an ABAP programmer in the SAP implementation team, but it would have been about the same time, actually. I was there 2001.
I started in 95 with what was actually then Coopers and Librarians straight out of school. So I got a traineeship, which was a fantastic way to do it in my mind. I would have my time again. I would do it exactly the same way, I think.
And so what era was it when you joined Sydney Angels? Roughly what time frame was that?
Like 2008, 2009, so right at the very start. It was coming out of GFC. There were angel groups pretty much in every other part of the country, really apart from Sydney. And PwC at that time, Steve Marbani was actually helping the Sydney Angels team actually create and do that formation. And he introduced me to it to actually get involved and join the committee at that particular point in time, and volunteer committee of 10 people working through trying to make it ultimately long-term sustainable, build up the membership, get deal flows, help put systems and processes in place to make the organisation, sustainable organisation, bigger than ourselves.
Yeah, fantastic. And obviously successful. Sydney Angels today has grown significantly since then.
Yeah, it's about 100 members. We lose track of the number of deals in total. They're approaching 90 investments now in that kind of time frame. Has taken a hell of a lot longer for investments to go through from the starting position to the ending position. I think when I very first started, people used to talk about 4 to 5 years was a sort of investment time horizon. Now I think when I look at things, I consider I'm going to be in everything for at least 10 years from those very earliest stages.
Yeah, and one of the topical businesses at the moment is Employment Hero, that's just raised, I think, 263 million. And you've been on that board for a long period of time. That must have been an amazing journey.
Yes, I've been on the board right from the very start, from actually what we called at the stage a Series A, because it was the first main raise when the investors came in. So I'd met Ben Thompson whilst I was at PwC. PwC supported a group called Entrepreneurs Organisation, which Ben was a part of. As part of that, we offered them a range of free initial consultations. I met Ben as part of that. We got on really well. I started doing some stuff with Ben, and I've been basically advising Ben from the start, pre-Employment Heroes creation, when he had his other businesses. And I worked with him on an advisory board in the first instance. That would have been 2012. So I'd left PwC at that point and helped him with the first raises in that business, and joined the board as actually one of Ben's representatives. So he had 2 board roles. So he had one of those seats, and I joined as second board seat as his representative. And I've been right all the way through. So it's been amazing, to be honest.
Yeah, and it's been a really interesting story in general, but it really kicked off interestingly via a sort of a debt funding, didn't it?
Yes, Ben is a phenomenally successful entrepreneur and had a couple of businesses in that HR space and performance, and Partners for Growth supported the business in that early stage and provided funding as that to the businesses. And in effect, the Employment Hero spun out of his Employment Innovations business, which was an HR consulting payroll bureau, and really was taking the learnings that they had, and then what was very much a paper-based process, and Ben saying this can be done better. It's a terrible experience for employees. It's a terrible experience for employers. Why are we not using technology to do this stuff? And he started building the tools at that particular point in time that he wanted, and said, this opportunity is fantastic. I need to spin this out and create Employment Hero standalone to let it do what he thought it could do. And it's done that probably multiple times over and got a long way to go still.
As an advisor to early phase founders, and we're on a board together, and we know that it can be sometimes challenging because they've got to make their own path and do things and learn lessons along the way. What's your approach as an investor to working with founders and trying to provide advice and guidance, and sometimes it being easier than other times?
I think I try to start by, in the first instance, asking lots of questions just to try to understand how they're thinking about things, what the opportunities are. We started this by saying I'm an accountant, I'm a numbers person by background, so I will delve into numbers because in a lot of cases the stats don't lie. So you can record and you can measure things, and then it's around asking questions and analysing things around that. What can you actually learn? I've seen a lot of really good entrepreneurs, when they're doing tests of things, sometimes don't go and ask the next question, which is, what have I actually learned specifically from this experiment, and what would I do differently knowing what I know now around that? And I think sometimes just asking that question to people just to prod them along, and you actually see history's not exactly the same, but it rhymes. Like the businesses in different areas see the similar kind of mistakes, and entrepreneurs face the same kind of challenges as they're growing through and discovering what their customers want, how to grow the business, people issues. So it's actually helping them prod them for those things that are upcoming around it, but not explicitly giving people the answers to stuff, because often situations are different, and the answer that I would give or someone else would give is more likely to be wrong than actually right.
I want to pick up on one thing you said there, looking at the data points and being analytical when looking at making an investment. Are there other more subjective elements that you look for too? Is there ever more of a gut feel or an assessment of the founders themselves?
Yeah, so from an investment perspective, absolutely huge gut feel in my mind. One of the traits that I think is the most important for entrepreneurs is actually resilience. And it's arguably almost impossible to determine, is someone resilient, by looking at numbers around it. And you can't tell from having a small one-off conversation. So a large portion of that is pure gut feel around it, seeing what kind of challenging situations they've been through, how they think about things. When you actually push and prod them and challenge them, how do they actually react to that? All those kind of things come into it.
Have you ever thought about putting them through the ringer on some sort of constructed experiment to gauge any of that?
No, I haven't. I've had a couple of entrepreneurs that we've looked at backing that we've used fingerprints for success assessment tools,
Yes,
especially
Michelle.
when there's teams involved.
Yep.
It's quite fascinating because I think it lets people learn how they interact with each other. And I've seen a couple of people use it and said, okay, now that makes sense why I do things this particular way around. And don't like this thing, and this is how I deal with it. And therefore, it's been really useful for teams.
Yeah. Yeah, absolutely. I think giving individuals that common language in which to communicate those different styles, and the understanding of other styles, and the acceptance that we have a style and that others do too is often really useful.
I think for me, there's the style aspect, and I think understanding and acknowledgement and understanding team dynamics can go a long way. Worldview, behaviors and values. I think as I get older, I realize that there are situations where those are incompatible, and an understanding of those things isn't going to suddenly mean, oh, okay,
Yeah.
it's all good. I can But those ones are even harder to try and test and understand than style, because until you're faced being in the trench and seeing how someone's worldview plays out, the default behaviors that happen and the value system that they're coming from, yeah, barring some kind of simulated Charlie Booker style Black Mirror project, it's just a bit hard.
And I think some of the simulation stuff can arguably work, but it's often quite contrived. So it's actually hard to put it into that real world situation.
Answer sometimes is easy to, through the questionnaire, you know what the right and the wrong answer is going to be.
Yeah,
so you just
exactly.
It's interesting because when you spend time with entrepreneurs, like someone can be fake for actually a relatively short period of time. It's quite easy to hold up a mask and act an image and actually pretend to be something that you're not. But the more time you spend with someone, the harder it is to actually do that. So I think that building that relationship, building that engagement with people is important. Spending time with people multiple times around it as part of my notional due diligence around. Sometimes I've got a gut feel about whether or not I want to do an investment very early on, but I still need to sanity check that by spending time with people as well.
What would be the average time frame that you take to complete a deal, and what does that look like for you?
So me personally, or sort of Sydney Angels as a business, or
I'm curious with you personally.
So a large amount of it depends on whether I know the person beforehand or I've come across them and followed them, and even from a distance sort of seen some of their content or met them in different environments. So if I've got some form of relationship with them, if I see the pitch and I like the high level stuff, I'll do some analytics around it. But I would generally have made a decision within a week or two if I think I really want to do it. Maybe it's the other way. I've made a decision very quickly if I don't want to do it around it. And then sometimes I'm just looking for more validation to do it. But generally, roughly that sort of couple of week time frame, that's probably the notional one. But then you would maybe backfill proving some data points or getting a little bit more information or just testing some theses that you have around it and exploring how founders think.
Yeah, that makes sense. And then how long post-investment do you feel it is until you really get to know the founder?
Possibly you never fully get to really know the founder. I think it depends on the level of interaction. So I've got a number of investments where I'll call it purely passive, cheer from the sidelines, offer a little bit of insights or questions of advice, get shareholder updates, through to ones where I've actually joined the board. So I'm quite intensely involved with them. So those ones, in the early stages, I like companies to have monthly board meetings. I think the cadence of change is quite intense, and I think a longer time frame than that allows too much water to go under the bridge before you start iterating things faster. And so it still probably takes 6-12 months before you get, a really good feel for people. But it always changes. You can have an impression of someone and then COVID happens, and how they react in that situation is completely different to how they would react in other situations.
Yeah. And also the founder's own personal life cycle in their own, everything else that's manifesting and how they're transitioning or changing through that too. I'm curious, what do you look for in terms of the business fundamentals? Are there specific metrics that you're measuring against, specific things you're looking for in their business model or financial modeling? How do you make those assessments?
Yeah, I'm quite often investing very early, so sometimes pre-revenue, but other times, even if they do have revenues, it's quite early stage in revenue. So you may not have a huge amount of data available. Yeah, they haven't perfected how they're doing the sales and marketing and customer acquisition 9 times out of 10. Therefore, they're still working through those things. So I focus very heavily at the early stages on the individual person. That's almost the critical thing. If everything's brilliant about the business, but the person see yourself ultimately backing that person long term, then I just don't do the investment, full stop. Whereas a smart person can solve problems. So I'm looking for the person in the very first instance. I do want the opportunity that they're working on to be really large, because for really large opportunities, you don't need to get everything perfectly right to get a really large scale business. When I'm engaging with them, I want to feel highly energized in the interactions with them. I heard this interesting on a podcast, I can't remember which one it was, but talking along the lines of, every time I have a conversation with someone, do I come away with that feeling like I've got more energy from that conversation rather than less energy from that conversation? So I think that's actually
That's
really
powerful.
powerful.
Okay.
And if you're an extrovert founder, I think it's easier for an extrovert founder to win in that kind of situation. You do need to try to judge whether or not some other founders are maybe not so extroverted around that, but you still want to see them excited and passionate about the thing they're going to do, because it links back to that earlier conversation around resilience, because they're going to go through really tough situations where the ordinary person will actually give up and actually stop working, and you can't have that. Otherwise, you may as well just throw your money out and rip it up and flush it down the toilet. So I think they're the ones. And then the other one that I'm probably a little bit to see is a little bit around the financials. So financials at the early stages are ultimately completely rubbish. You're never going to achieve the forecast you actually have. But I like to see how the founder thinks about financials. Is it going to be economically viable? Do they think they know how to make money? Do they think they know what the kind of unit economics will be? Are they going to be able to acquire customers? And so does it actually stack up in the long run? Because I think if you put all of those things together, you've then at least got a fighting chance to last long enough to solve the problems and actually grow a business that's actually meaningful.
And with your especially angel investing, but then also your syndicate work, so you, correct me if I'm wrong, head up here Startup Heroes, you then inevitably end up in a situation where you're representing other shareholders. And how do you find that, I guess, interaction going back with them? How do you handle it when things inevitably aren't going that well? Sometimes there can be pressures from other shareholders to, I want you to go and do this and this. That in itself is an interesting part of angel investing that I'm not sure a lot of people realize.
Yeah, I think it works for both the Startup Heroes syndicate, but also the angel groups working together, because you're representing a group of investors. But if you're on the board, I still remind people there's a fiduciary duty that a person has, not just to the investors, but to all stakeholders in the business, which is actually critically important for people to be aware of. And I think I also point out to people, very easy to throw rocks from the sidelines or say, you should do this or you should do that, or why aren't you doing these things? And they're not fully aware of all the conversations that actually happen. And 9 times out of 10, the stuff that's been suggested has been spoken about, has been thought about, has been explored. It's not some people are not just walking around blind, willy-nilly, not thinking about how to solve problems around it. So I think you've got to be firmly pushed back to people, but be respectful of it. But people do also have good ideas. So it's a fine balancing act around all of those kinds of things. And sometimes things didn't work at a particular point in time, and you need to remember to come back and try them at a different point in time, because maybe they will work because other things have changed in the environment or something's become more progressed.
What is the decision for you to join the board, like to become a director versus not in one of your portfolio companies?
I probably need to have an extra strong connection with the founder as probably the starting point. It needs to be an area that I've got a pretty deep interest in, or in some respects a highly challenging one. So over the years, I've thought about what are the things that drive me, where do I get my energy from stuff, and it's actually helping people solve problems. So as I'm helping people work through challenging issues, that's when I'm having the most fun around it. So I'm probably more likely to join something that's more challenging rather than less challenging in the first instance, because of my also broad background around capital advisory and M&A. Ones who are going to be going through that journey where I can provide more insights, I'm probably more likely to get more hands-on for those kinds of ones as well.
Yeah, it's interesting. You made a really good point before about the director's duty to all shareholders, but I've heard some early stage founders look at a director role as an opportunity to protect their own investment or their own interests. Do you see that conflict playing out a lot in the boards that you're involved in?
I don't. I think from time to time you sometimes do, where you've got, if you've got an investor on the board who's got really deep pockets and has a capacity to follow it all the time, sometimes there's an incentive to just do it fast and not necessarily test the market and get the full price. And it's not always about getting the absolute best price on a capital raise. There's a balance between getting it done quickly and efficiently so the business can get focused back on it. But you also want to have, you need a fair outcome for everybody. I mean, the person who gets diluted the most in capital raises in early stage companies is the founder, right? And if you get to a situation where the founder doesn't have enough skin in the game or enough upside in it, they get demotivated. And if you get a demotivated founder, all investors lose. So I think making sure you've got that balance right is critically important.
Yeah, absolutely.
And you mentioned before, Sydney Angels is about 100, Brisbane Angels is about the same size. I think Melbourne's probably not far off. And given the opportunities, but also the interest and the networks, what do you think stops more people that have the capital and the potential interest from getting involved in early stage investing? And what are some of the ideas maybe to get more people involved?
So I think there's probably two components. It does actually, to do it properly, it does actually take quite a lot of time to do it right if you want to be hands-on. So I think there's probably multiple ways that people can get involved. If you want to be hands-on and active, spend the time. Being an active angel is a good way to do it. If you don't have that level of time, then I think joining syndicates, another way to do it, or alternatively investing in funds that tap into it. Now, if you want to go that super early stage, whilst there's lots of funds that talk about going really early, there's not a lot that genuinely go very early into that. I think the other thing that stops people is that people think you need to have you need to write much bigger checks to be an angel investor than what you actually really have to do. And so my first checks are normally $10,000 to $20,000 in each one I go into. Part of that, is it 10 or 20, depends on a couple of things, how high conviction I want to be in it. Sometimes, capital availability at that particular point in time also comes into it. I've never done less than 10. I've done more than 20 a handful of times for those really high conviction ones. But you need a really diverse portfolio as well. So I think that's the other thing, is that people start by thinking they need to write bigger checks, realize they need to be diversified, and then therefore say it's too hard and don't do it. Whereas start much smaller and be diversified and look at lots of deals.
Yeah, in Brisbane Angels, there have been times where people have come in and assumed that they had to write $100,000 or $150,000 check. They do it a couple of times, inevitably, because they haven't taken a portfolio approach. Those ones get into trouble, so it puts them off the asset class, whereas actually, like you say, even some of Australia's biggest angel investors are in the 10, 20, 30,000. Now, when it comes to follow-on, depending on what your balance sheet is, follow-ons is a different game where you see 6-7 figure checks, but at that early stage, size of wealth is not as relevant as portfolio diversity.
I think that's right.
I'm curious, Adrian, the deals you've missed, like we all have them. Are there any noteworthy ones where you didn't go in, and in hindsight, was it a question of incorrect decision making, or was it the right call at the time?
It's a really good question, because there's probably a handful of ones where you could have got in at the time. For example, as they play. So Get Swift, what was Get Swift originally pitched to Sydney Angels at a low deal, then came on, got an extraordinarily large valuation on markets, and then ultimately crashed and burned. Arguably, at the time of missing out on it, seeing at some extraordinary valuation, you would have said, oh, missed out that one, that was the wrong decision. In hindsight, turns out it was, if you didn't get out, it was actually the right decision around it. I probably don't dwell on the ones that I miss out on. There are a handful of them, but I think at the time I wouldn't have necessarily made the different decision around it, because there's obviously clearly something about the deal that I didn't like at that particular time, or I didn't have enough capital. I've had a couple ones where I would have liked to have gone on, but I just invested in something different. And you go, okay, I missed out on that, but the one I did invest in still did really well. So it doesn't really matter that much around it. I don't think you can cry over spilt milk either on that stuff. There's no point in dwelling on the past.
No, I think that's right. I remember sitting down with Tim Fung of Airtasker when the pre-money was 2 million, I think, or 2.1. But at that point in time in my own entrepreneurial journey, I'd been introduced by my shareholders, and I hadn't yet learned things about portfolio approach, and I wasn't actually at that stage what you would consider an early stage investor. And so at that time, my capital was my capital and a bit scarce, and the decision was the right one at the time, because it would have cost the business something, because that's where the money came from. But going forth, if you take more of a portfolio approach, as you say, you can't dwell too much on the On the prior ones, you've just got to try and do the best you can to have a good deal flow that gets you into the right deals, because early stage investing is this power law thing and you've got to have the portfolio.
Yeah, 100%.
What about the ones, Adrian, where you have invested and maybe it hasn't gone to plan, and appreciating you may not be able to speak freely of exact companies or names, but how do you handle those where it's become clear that it's just not working out, or for whatever reason you might not want to be involved as well as a different reason?
It's quite interesting because at the very early stages, in a lot of cases, if the company is going to fail, it normally fails relatively quickly, normally within the first 12 to 18 months. But it depends on why it fails. If the founder has done absolutely everything they possibly can to get through, yeah, there's not much you can actually do around it. If they've given up, and I've actually had one scenario where the founder effectively gave up probably 12 months after investing, and it was a super disappointing one. The mistake on that one, it was basically a reset of the business. So the founder had been working on the business for 5 years already. And I think if you had a scratch beneath the surface a little bit more, you might have found out that they were a little bit tired and maybe weren't quite as energetic as they were making themselves out to be. They tried multiple things. I think that in that particular one, the most disappointing thing for me is I had a conversation with the founder, and I checked with the founder on a regular basis, wasn't on the board, talked about raising, talked about strategies for it. We'd had a conversation, and then 3 weeks later, he pulls the pin. And I'm like, we had a conversation 3 weeks ago. There was no inkling whatsoever that this was that. So that was probably a really disappointing one. Now, I reflect back and say, did he feel like he couldn't tell me at that time that he didn't feel that way? Because I was maybe over enthusiastic about the opportunity, because I do tend to get enthusiastic about the opportunities I get involved with. I think you have to be a positive, that kind of person to support them, because being a founder is a lonely journey, right? So it's really super, super hard. And sometimes you need to help pump them up and remind them that things aren't as bad and everything's not going wrong, but things are actually good, and what they're experiencing is exactly the same as what everybody else is experiencing. So
yeah, we look at other companies and say they can't possibly be having the journey and the pain that I'm going through, but actually just below the surface, there's a common pattern.
And it's unfortunate, but there's also a significant amount of jealousy in the early stage ecosystem as well. And it's with investors who say other investors do spectacularly well on stuff and saying, oh, I missed out that one, I could have got that one. But it's also founders seeing other founders raise large sums of money and saying, oh, hang on a tick, how the hell did that person raise that amount of money? They're not working on something life-changing the way I'm working on something life-changing. You saw it in particular at the time. The one that stands out for me is Milk Run. When Milk Run did a really large round, everyone sat back and said, they're just doing groceries. Like, how the hell could those guys raise 70, 80 million bucks to do that? Makes no sense whatsoever. So when it failed, there was a small part of the ecosystem that almost celebrated. They were happy that they failed because they didn't actually get through, because, they managed to raise a huge sum of money when others didn't. And I think that's disappointing in some respects.
Yeah, definitely. It's a weird quirk of humans that we find a sense of contentment in normalizing our experience. And when others are doing it tough, it becomes quite cathartic for ourselves with our own situations. But it can, to your point, it can be quite negative. Like, it can be a detrimental thing for the ecosystem as well. But look, I know myself, I've done this a couple of times in business, even just recently, like chatting to others in very similar places and hearing their struggles. I do find some sense of empowerment in that, in terms of my own struggles. And that's right. This is hard. And
why is it hard? It's supposed to be.
Yeah, exactly. This is the normal, as opposed to feeling like you're the abnormal.
And because you're operating from a position of influence, even if you're on the board, it's higher influence than, say, not being on the board. Because you see so many other stories and you're able to pattern match yourself, what's your approach when you can see a founder is a little bit off track, but could get back on track, at least with regards to other patterns you've seen? How do you approach those conversations? How do you try and share that experience and that influence? Because some people in the ecosystem, I think, going a little bit too heavy-handed, and that ends up repelling the founder. So what's your approach?
I think my normal approach is I'm trying to ultimately be supportive with the business in the first instance. So it normally comes from the right starting position. So in some respects, you start by just asking some questions around it. And then if it starts going in the direction, there's a huge amount of times the founder knows what they actually need to do, but sometimes they just need some validation around that. So it's actually helping
Bit of
giving them that
confidence.
confidence to actually get through and that things aren't as bad as what they think it is. But sometimes they are genuinely going, well, I think they're going in the wrong track. So either, and we can't both be right and we're not both wrong. And there's just as good a chance that I'm wrong for whatever reason, because I'm also not living it and breathing it in the day-to-day basis. So sometimes it's really just asking questions around, help me understand your thought process, what you're doing in this, and then asking questions about, and actually one of the most powerful questions sometimes to ask is, what if you're wrong? Like you can be 100% convinced you're doing the right thing, but just then thinking about saying, let's just pretend you are right, but just what if you are actually wrong? What does it look
What
like?
does it
What
look
does
like
it actually
then?
mean? What would you do? What could you possibly do differently? If there's a really clear example where I've seen someone else try what they're doing, I'll actually tell them, saying, yeah, here's a scenario, here's a situation, here's why I think you might be on the wrong track. And maybe these are some things you might want to consider about doing it. At the end of the day, they need to make the call and decision on some of these things themselves. You can't force them. You can't force them to do it. All you can do is help guide them along, give them some evidence, sometimes suggest they go and talk to those other people around it. But every single situation is different around it. On the alternative you're giving them is based in a different environment, a different scenario, different capital, different competitive environment, different product, different customers. So you need to learn to adapt to all those things.
I love that question of what if you're wrong. One of my favorite little go-tos is, what if you were wrong? What would be the indicators that we would see? So having something that you can actually measure, because often the founder with the high entrepreneurial energy is incredibly positive, sees eternal optimism and opportunity, and doesn't actually take a moment to have some yardstick to know when it's not being successful, or a particular strategy isn't working. So yeah, actually pausing to get them to reflect, what would we be seeing if you were wrong? And are any of those indicators already here? Or what do we do when we do start to see those indicators?
Yeah. It's very difficult giving advice to founders around it. And I actually see founders get a lot of advice from other founders, especially when it comes to things like capital raising in the very early stages. And in my view, a lot of that advice is actually quite poor advice, because most founders in the early stages will give advice on the basis of what specifically worked for them. And that's the only framework and almost the only context they have in that environment. They haven't actually seen hundreds of pitch decks. They haven't actually met with hundreds of founders, seeing how people actually pitch, with investors about how they think about it, how they actually make decisions. They haven't spent time trying to walk in the shoes of the investor if they're trying to raise capital around it. So I think in some respects, founders take too much advice from other founders in that one. They knock back some of the advice from investors because they come at it from a perception that the investor's just trying to get a good deal for the investor's perspective. So when the investor says, your valuation, I think your valuation is too high, it's off, they think, oh, you just want to get a better deal. It's not that. Actually, maybe the investor's genuinely right and the investor would invest in you at the right deal, but at the right price, but they're just not going to invest at that particular price because they're seeing the hundreds of other deals that are out there in the market and the hundreds of other startups trying to raise capital at that exact same point in time.
And often, especially around that valuation or even quantum, sometimes the conversation you're going to have look is we always invest in founders and businesses that we believe are going to be successful. At no point have I ever said I'm going to invest in something that I don't think is going to work. But a good percentage of time, it doesn't. And even our own judgment who do this professionally, the power law aspect of it means that quite often we're wrong. And so what that means is it's not a reflection on you, and it's not us trying to be doubtful or too aggressive, but in order to be successful in this business and make sure that there is some capital to return into the ecosystem, so then that way the machine goes, so that way the machine continues to turn, we have to ensure that we risk mitigate. And some of that means that, okay, the valuation and the opportunity has to stack up in a broad portfolio sense.
Yeah, I think that's right. Too many times, I think founders want the absolute maximum valuation they can get at any particular point in time, and it's good in the it's good in the very, very short term. It minimises their dilution, potentially doesn't get necessarily the best investors on, but every founder believes when they're raising that money that everything's going to go perfectly well and they're not going to have any issues down the track, and therefore, of course, their next round is going to be an up round valuation. But life doesn't always work that way.
Yeah. And Aaron often laughs, but I have my own version of startup bingo. And until you've had certain slaps in the face, falling in ravines, and whatever else, the universe in startups doesn't actually let you get to the next stage. So anybody that's had too easy a path often doesn't yet have the foundations for the really difficult times.
Yeah.
What are you seeing, sort of segueing a little bit? There seems to, my first sort of, I think close to the last 5 years has been very, here's the product, here's the problem, and here's how we're going to go forth and capitalize on it. Now we've got this almost appendage of those things are true, but we're bolting on AI. And if before AI, it was blockchain, and before blockchain, it was cloud. And what are you seeing with this AI world in terms of early stage investments, and how are you approaching it?
With caution is how I'm approaching it. Just generally, it's a super interesting and exciting opportunity. If you sit back and reflect on technology changes, it does feel like this is the next big sort of quantum step change from a technology perspective and how it actually gets applied. I think I've got, at this really early stages, almost zero chance of really being able to identify and pick who the winners are going to be. If you're following the space at all, there are thousands upon thousands of startups doing stuff in this space and experimenting and launching things. And in this environment, it's become super, super easy for people to launch stuff. So the low code, no code environment, plugging into other systems and tools, lots of people are actually experimenting and building stuff, the vast majority of which will fail, probably more so than normal kind of startup investing. I personally think the winners in the space are going to be the ones who leverage AI into something else, or on top of something else, potentially with either proprietary information or some strong, deep relationship with customers. You got to come back and, in my mind, be still solving a completely valid problem for a customer and have the solution for it. In some respects, the customer doesn't care how the problem is actually solved. And I think this is a similar thing with blockchain, right? So I don't care how electricity is produced. All I want to know is when I turn the light switch on, the light comes on. I don't actually need to know anything more. And I think that goes the same for some of the blockchain and AI stuff. Is the customer's got a problem they want to solve. They want to actually have that solved. They're not that fussed how it's actually solved. But as an investor, if AI genuinely could come in and completely disrupt that solution and do it at a fraction of the price, then I think it's something to be concerned by. But I've got no hope in hell in picking who the winner's going to be. So my initial reaction will be is I'm probably unlikely to invest in an AI startup unless it's just one component on top of lots of other stuff and it makes sense that it's a completely logical application of a tool.
And Adrian, how do you stay up to pace with the latest tech, and where do you draw your insights from to keep up with changes in the market, changes in the business landscape, but also the technological landscape as well?
There's heaps of newsletters and databases, and just browsing. Podcasts are another one to look at things. Listening to some of the global podcasts are quite fascinating around the things that are actually coming through. I also follow a number of syndicates on AngelList as well. So seeing the deals that are coming through there and what people are doing is getting information around that, other things that are actually out there in the market, what people are actually working on. In a lot of cases, being done by syndicate leads that are much smarter and much more experienced than I am. So I'm actually learning from the kind of things that they're learning from. Sometimes you just go down the rabbit hole on Google and you find something that's interesting and you think you're going to spend 10 minutes looking at it, and about 3 or 4 hours later, you're still reading and clicking links.
Yeah.
And there, you just mentioned AngelList and some of these other syndicates. there's been an explosion in the last few years of the syndication model, syndication infrastructure, then syndicates built on top of it. Do you see it sustainable? Do you see it continuing that way, where there's just this absolute proliferation? Is that going to give birth to a new boom of early stage businesses that we wouldn't have seen before because the capital wasn't available? Where do you sit there?
I think the key benefit of a lot of the syndication platforms and things that are coming through is that it is enabling people to do very small bets and small checks, $1,000, $2,000, and therefore, for a relatively small sum of money, you can actually build a very highly diversified portfolio. Now, I think a lot of people also go, it's only $1,000, so they invest in a whole lot of stuff they shouldn't invest in. So I think the risk of loss is going to be greater. Some syndicates are really good. They actually do proper DD. They do communication. Others are terrible. You send them the check and then you hear nothing back from them whatsoever, no matter how many times you follow up and just say, hey, is the company still alive on it? So I still think there's such a significant opportunity for new investors to come into the ecosystem. Very few people invest at the early stage. But if you look at the Australian market, almost every single person technically invests in the VC space via their super funds, right? Because their super funds have all got investments in VCs. So they are exposed to the space. But we just need to, I think, get more people interested in doing it more directly and actually picking things up themselves.
And I guess those syndicates that are weaker on some of the compliance and the communication will just weed themselves out. The challenge becomes is, as you said earlier, people used to think this was a 4 to 5 year game. It's actually closer to 8, 10 and 12 year game. And backing the right ones takes a little while to weed out the good syndicates that can find good deals and support them properly.
And I think, and the better the company, the longer it takes to come through, and the more advanced it becomes, and the more convinced you get it's going to compound at good growth rates over coming years. So it might be 7, 8 years before it really gets strong momentum and gets to a key milestone. But after that, it will just continue compounding at sort of 20, 30, 40% per year. And all of a sudden, those numbers become extraordinarily large once you get to the back end of those. I think the other thing, the ecosystem we're obviously starting to see a little bit in Australia is around the secondaries. So I think as our market depth becomes bigger, if you start seeing more of those kinds of things, that will actually enable more money to come back into the ecosystem and start recycling that capital through. So I think the US market's got a lot better at that. The Australian market's still well behind, which is not surprising given that we started much later and off a lower base. So I think those things will actually help improve the ecosystem as well.
Yeah, it's been good to see that rise in secondaries recently, both at the top end of funds, but also founders themselves opening up some secondary opportunities for investors. So yeah, definitely an evolution of the ecosystem. Still on a per capita basis, still a long way for us to go in terms of VC capital funds deployed by global comparison. What are your predictions for the next sort of 6 to 18 months in the market?
I'll probably be wrong. I think we're starting to see a couple of larger deals happen. Markets turn back up. I think there's been a significant amount of uncertainty around inflation, interest rates, unemployment. The media and politicians have done a spectacular job of telling people how we've got terrible times, things are tough. That just makes people, in my mind, be more conservative, restrict spending, which then becomes a self-fulfilling prophecy in some respects. But I think if we get the confirmation that interest rates have hit their peaks, at that particular point in time, people's view, actually we might stay flat for a period of time, but the next rate change is more likely to be down rather than up. And I think that in itself just creates a significant amount of general positivity for that, because there'll be a point in time when people say the worst is behind us, and therefore things will generally get better. So I think in 18 months' time, it definitely will be a substantially better position for markets generally, from investing, generally capital availability, generally, than we are today. How long it takes to hit that peak, is it 6 months? I'm not so sure. But I think in 6 months, it's definitely going to be better, but 18 months is definitely substantially better, I think.
What I'm starting to see, though, and maybe this won't play out, but essentially for the last 10 years, there's been enough, in my experience, and I could be wrong, but founders were able to raise multiple rounds of capital And if things didn't quite go to plan, there were some people willing to give them another shot. It may not have been the existing shareholders. It could have been other shareholders. But now I'm finding in the last 12 months properly, actually, if you haven't been able to say, this is what I'm doing and I've achieved the results, even if I need more capital, the world is becoming harsher for those. And I think that come early next year is actually going to get a little bit harsher. What are your thoughts on that, or am I experiencing it different?
I disagree with that. I think there's a lot of cases, and part of that I think is because a lot of the money is getting raised in those early stages from angel investors, and then angel investors often run out of capital, and therefore you do need to find a new group of people to support and champion it. And there is a degree of sometimes at the early stages things take much longer. So the first angel investors heard the story before and says, "You're just telling me the same pitch that you gave me before. You told me last time this was the last amount of capital you raised before you get to break even, and now you're telling that exact same story again." And you've got great excuses to why that's not the case. These are the things that you didn't envisage that was going to happen, but you're going to need to go find that new batch of people. And I think that's also partially a function of the market. So whilst the Australian VC ecosystem has got substantially more money in it than it had before, it's in a lot of cases made up from funds that have much, much larger pools of capital. What I've seen is when a fund has a much, much larger pool of capital, they tend to invest larger checks in deals. So we've got an ecosystem where it's relatively easy for a company to raise $200,000, $300,000, $400,000, $500,000 up to about $1 million through a group of different angels, groups, syndicates working together. And then if you've broken through and you've got to the stage where if you've worked out your marketing, how you're going to acquire customers, and you want to go raise $5 million or $10 million, that's arguably easier to do. But there's still this really difficult gap for somebody who wants $1 to $2 million, because a really large fund genuinely doesn't want to write a $2 million check, because they have to do the exact same amount of work to write a $2 million check as they need to do to write a $5 or $10 million check. In fact, arguably it's easier to write a $10 million check because you've got more proof points and more data than a $2 million check. So I think we've built up this ecosystem. We've done really well around that, but I think we've created a different problem, which is almost back to the problem we had 10 years ago, where it became hard to raise $1 to $2 million, and we sort of start the life cycle again. So yeah, Don, you're right. You've got to get out and you've got to find people and talk to new people. The one thing I say to founders is that the more you communicate with your investors on a regular basis, where things are good and bad, the more likely they are to continue to support you. And many founders hide the bad news or attempt to hide the bad news, thinking they can just solve the problem and then the next update's going to be a positive one. And all of a sudden you miss one update, and then you miss another update, and then you miss another update, and then all of a sudden the next update is, "Oh, we're out of money. Can you please give me some more money?"
I need some money. Yeah. And for people that have been investing in this asset class on a portfolio approach, you do know that if everything's too rosy, that's not right. And what you're actually trying to understand is, do I have a trusted relationship here, and will they tell me how it is, given I know that it can't ever be perfect? And often what I find is sometimes, especially first-time founders or a first few years in, the business is a direct reflection of them personally, and they get their personality a bit too connected in with it. So when the business is doing well, they're doing well personally. And when the business is doing poorly, they're doing poorly personally. And when you're doing poorly personally, you don't really feel like communicating and sharing. And so if I smell that, I try and have a conversation of, you've got to be you as the human, and you've got to have the business. And whether the business is doing good or bad, we need to make sure that we stick to a process of honest, empathetic, trusted communications. And otherwise they get into a pattern of behavior, just like you just described there. I'll wait till it's better. I won't do it now because I can just fix this. And inevitably that never comes. And before you know it, they've dug themselves deeper.
I think that's right. And every single person who's been investing in this space at any time realizes shit happens, things go bad, everything's not rosy. And sometimes, what's the saying? A problem shared is a problem halved. And I think that's 100% correct. You put your ask out and tell people what you're struggling with. And there's a reasonably decent chance that somebody knows somebody who can actually help out with stuff. Because people do want to help. They bought into the vision. They bought into you as the person, as the founder, actually going through and doing that. So they've put their money where their mouth is. It's in their it's in their interest to actually help you get through it.
I think one of my favourites is when it's a few months down and then you'll get an update and so I remember this issue happened. No, what are you talking about? Yeah, it was page 11 of the board report. Yeah, I clearly stated that we had lost that contract. Okay. That then becomes all a bit too cute. Now I understand why there's those impulses sometimes, but honesty often is just so important, and we find time and time again people will continue to invest even if things aren't perfect, if they know, to your earlier point, they're doing the best they can, they're up front, and that's really important in that early stage.
If they're doing the best they can, you've got a good relationship, they've got good communications, you see they're actually still progressing forward. So it might not be you hit every single milestone and metric you thought you were going to hit, and you still believe in the opportunity. And actually, in a lot of cases, the opportunity, once people get into it, becomes far greater than what it was than what it was very early on. And I think people lose sight of that. I'm very conscious that it's very difficult being a founder. Like, especially if you're a solo founder, but even a couple it can be super, super lonely, right? Because you've got to put on the front for the whole team that everything's positive, everything's going well. You might be saying, hey, I don't think I can actually make payroll next month, but you still got to have everyone driving in the same direction to actually get it, because you're trying to scramble and raise capital to make sure you can make that payroll. But you can't say any of that to your team members. Maybe you should, depending on the relationship you've got with your team members, and get everyone making sure they're...
Should is the most dangerous word in the English language. Should versus is.
Yeah, look, again, I think you've got to have that relationship. It all depends on how you set the things up front, right? On that honesty, the get everyone firing. I think the founders that do it best have a very clear, big, bold vision that drives them passionately. They get the team members to buy into that exact same thing. So those team members will go above and beyond and do stuff that the ordinary person wouldn't do. And all of a sudden, you've got every single person rowing in exactly the same direction, is all drunk the same Kool-Aid, and you've got investors who have done the same thing as well. And everyone's prepared to back and go more and go again. And you see it time and time again that people want people to succeed and will help as much as they possibly can.
And with that help, I think it's been a few years we've been on a board together, but angel investing and early stage investment is obviously something you're very passionate about, but you also are part of Modus and also have the syndicates that you run. So could you give us sort of an overview of how you help in that professional capacity?
Yeah, so Modus Partners is a boutique corporate advisory firm. We do three main things. Founders, when they want to sell their business and exit the company. If they want to do M&A to buy other companies, so we help with the advisory around that. And then we also help with capital raising as well. And the capital raising could be a combination of predominantly equity, but could be debt as well. So it's really looking at the broad capital strategy. And then there's a whole range of services that sort of sit around that, which is normally growth strategy, capital strategy, all tied in with one of those aspects of it. We quite often try to take a long-term relationship with people, so it won't be just a sort of a one-off single transaction. Quite often it'll be start with one capital raise, move to another capital raise, then maybe some M&A, and then ultimately the exit transaction. It could be a 5 or 10 year relationship with somebody. What we try to get involved in from a capital raising perspective is probably slightly later stage companies. I think at the early stages, it's really important that founders put all themselves. Investors often don't want to have an advisor sitting in there and getting involved in the transaction. I think you can do it, but you've still got to have, the founder has to have the key point, they've got the key seller, they've got the key relationships and key interactions with it. So it's really helping people to guide to do things where they've never done the transaction before, or they might have only ever done it once before, and they're unlikely to necessarily do it. Most people only sell their company once, so they haven't done it. And back to my earlier comment, they take advice from people who've only ever done it once, as opposed to doing it multiple times, knowing how you prepare it, reaching out, how do you negotiate transactions to get a better outcome. And an advisor can say stuff that a founder or CEO can't say around it. There's normally some kind of earnout. That person's got to go and have an ongoing relationship with the buyer. And sometimes you can't necessarily be quite as aggressive as what you need to be in a negotiation.
That's a really good point. Yeah, you've got to be able to have some way of having those hard negotiations, but without burning the bridge, and having someone to blame afterwards is probably pretty helpful.
You can almost always walk, an advisor can almost always walk back a pointy negotiation at any particular point in time. You can always get the founder or the principal to ring the other side and say, he said what? I didn't authorise him to say that. And you can always walk it back. I have a view that if I don't feel like I've almost blown up a deal, I probably haven't pushed it quite far enough for my client.
It's a really good point. And also for the founder to better manage their mental health through that process too, having someone else leading that. The other thing I noticed, Adrian, that you do a lot of to help founders is the content that you put on LinkedIn. And I was actually curious from a just personal perspective. A month ago, you posted offering to review pitch decks for founders if they submit them. Did you actually get much of an uptake on that? I've got some,
and I'm actually working through some. What's interesting is what I want to do is review pitch decks and review them publicly and give feedback publicly to the founders. Now, that's obviously hard for a lot of founders to say, hang on, you're going to rip my pitch deck to pieces, which I don't intend on ripping anyone's pitch deck to pieces at all. But I think it's valuable for founders, but also valuable for other founders to see pitch decks, but also how an investor thinks about those pitch decks and things that you could do differently around it. So I do have a handful. I'm actually working through them. It's a bit of a little bit of a perfectionist on some of those things. So I've recorded a couple. I'm not quite happy with them, but I think I've got to just bite the bullet and get a few of them out. And I think that will also encourage other people to provide them as well, because I'll see that it's going to be still polite, frank feedback, but direct. But I will also get the founders to approve it first on that basis. And I've had a couple of calls with some as well.
I think it's hugely, there's a clinical psychologist, Esther Perel. She's got a podcast and she does anonymous sessions, either with couples, but she's got a business one called Workday or something like that. And she takes people from corporates, and then it's this live session. And because it's one thing to get theory and just general understanding of some concepts, it's another to watch it be applied to someone else. And then work out what the takeaways are for you. So I think that'd be great, because I tried pitching that, not pitch decks, but just almost sessions. But the founders often get stuck with, I don't want confidential information out there, and I don't want to look stupid. And so it's balancing those two things. But I think the more open we can be on some things, I think, great.
It's really interesting because in a lot of cases people learn from it. It's like when you go and talk to someone on the stage. A lot of people don't like public speaking, right? But the person on the stage clearly has a lower fear of public speaking than the people in the audience 9 times out of 10, because they're up on stage and the others are in the audience. And in a lot of cases, the person on stage is an expert in something. And to be an expert, you actually only need to know a little bit more about the topic than the person that you're actually talking to around it. And people are generally happy to learn and experience and see different perspectives on stuff. So sometimes that was nice. Just do it is the right approach.
Yeah, I think for any founder listening, I would take Adrian up on the opportunity, as confronting as it is, because I took a group of 20 founders over to Silicon Valley, and we went into 500 startups and got to see some of the companies in the accelerator program pitching to a panel of EIRs. And the EIRs were ripping these pitches to shreds. That was the emotion of it. Every word was new. It was like, no, don't use that word. Use this word. Start again. And it was, but the value from that was phenomenal. Just hearing what goes through the mind of an investor as they're hearing a pitch in real time, and seeing these founders adjust their pitch in real time was just absolutely such a lesson for the founders.
And I think the thing about the pitch deck side of things and pitching investors is that I think there's a huge amount of time and effort that a founder puts into a pitch deck, and I think that investor will spend all this time actually looking through. And I talk about the flick test, and a few people have different versions of this, but I literally just flick through a pitch deck, and it's often as I've started doing, I've actually just been looking at it and actually timing myself how long I actually spend on it and what my first thoughts are. And they're generally 3 to 2.5 to 4 minutes. 3 minutes is about the average around it. And then just that sort of initial reaction of what the thoughts actually are after that for it, I think just gives a different perspective for founders, because I think investors in a lot of cases are too polite to founders. They give some wishy-washy feedback as to why it's not for them. They also want to leave the door open and say things like, oh, keep me updated and tell me when all this stuff happens. And the reality is maybe the answer is, I just don't get it, or sorry, I'm just not excited by it.
Yeah.
We have a view here that the pitch deck and the first pitch isn't to actually get money, it's to get interest so you can then go and have that conversation. And when you try and put too much into a pitch deck or don't clearly communicate it, then you're losing the ability to get that interest.
I think that's right. The whole point of that very first one is to get someone to say, that's interesting, tell me more, and just learn more and get to the next thing. In fact, every single interaction is, that's interesting, I want to learn more, or no, I don't need to know any more around it. And I have problems when I create decks myself for clients, stuff like sometimes it's too much detail around it. You've got to come back up and say, no, actually, what's the purpose of this particular one at this particular point in time, or the intro email that you send to someone, or the elevator pitch that you say to someone. You don't do an elevator pitch and somebody gets their checkbook out or says, give me your bank details and I'll transfer the funds across to you. It's okay, let's catch up and learn some more.
Absolutely.
Yep.
Adrian, really appreciate your time. There's some fantastic insights in there. And like I say to listeners, I've had the pleasure of being on a board with you for some time. And when Adrian says the words rip apart or provide constructive feedback, he genuinely, it's not ripping apart. It is a firm but kind distillation. And I totally recommend taking Adrian up on that offer.
Thanks, Tom. No, it's been great. I really appreciated it. And I've been listening to the podcast as well. So I've really enjoyed the stuff you guys are doing and the conversations you're having. I think it's really valuable. It's definitely one of the best ones I've seen in Australia and or listened to in Australia.
Oh, thank you, Adrian.
Fantastic. That's great feedback. Thank you, Adrian. And thank you so much for your time today. I really enjoyed the conversation.
No problem.
We'll see you at the next board meeting.